So we're going to shift gears now, and we're really going to dig into the investing side of things. And I want to talk about investment edge and how you guys think about generating edge and superior performance. And also want to talk a lot about risk management and how you think about not losing money more than anything. And then we'll get into some other investment related ideas as well, including how to select a good investment manager, how not to get yourself with the wrong managers or in the wrong types of deals if you're interested in innovation in early stage companies. That's something I see a lot of folks making direct investments when they don't really have the experience to be doing so. A lot of pro athletes and entertainers are doing that. We talked about that offline. So I'd like to talk a little bit about how we can help protect folks from themselves, essentially. And let's start with investment edge. So everybody always asks this question, for athletes and investors, how do you create edge? How did you become good at what you did? And we could have a full separate conversation about how to do that on the athletic field, but let's focus now on how to create edge within the investment industry, specifically whatever strategies you're running. So most of you guys are early stage equity investors. You can elaborate on the details behind that. I'm a little bit later stage, so we come in at Series B and C when the companies have already done 3 to 5 rounds of equity financing and have a very solid growth plan and have revenue and really are just looking for cheaper capital to grow. So very complementary to what you guys are doing, but later stage and less risky because it's later stage, more developed companies. So when I think about edge, I think about ideas, connectivity, and the ability to execute. So it's really 3 areas. And a lot of these pro athletes actually might have naturally, right? In terms of connectivity, because you've got, brand and you've got, access to folks that others might not. And you also have the ability to execute, I think, at a level that most folks can't because of everything we discussed in terms of work ethic and discipline and teamwork, leadership, fighting through adversity, et cetera. And then the ideas, of course, depend kind of on the individual, but you guys certainly are good idea generators. So that's how I think about it, really excelling in those 3 areas: ideas, connectivity, and execution. I'm curious how you think about it. Why don't we start, Isaiah, why don't we start with you, and then we can go around the horn.
Yeah, I mean, so we're an institutional fund, and I've worn the hat prior, right, which is angel investing. Whereas it can mirror, there's a lot more flexibility in angel investing, right? If you have an institutional fund, you have fiduciary responsibility to really drive real value back to your investors, especially with a mandate that you've set out, right? Scope on stage, scope on domains that you would touch as well for that. So being very, very clear around that's going to be important, right? So as an institutional fund, there's I think an inherently risky asset class is venture capital, and driving as much of that risk out is really the job of a venture capitalist, right? Taking a lot of the unknown, or as much of that unknown, out, and putting process in place in this inherently risky asset class is super important, right? From deal flow all the way to diligence, all the way to finalizing deals, just having highly, highly rigorous and thorough process around that. Because why kind of leave anything up to chance in a process that you can entirely control, right? So kind of, around that is extremely important. I would say there's another aspect that we look at kind of reducing risk. And that is, I think a big driver, especially as we position ourselves. And, we've taken a research-backed approach to the space, right? So a highly, highly informed approach to the space. We had founded the Sports Innovation Lab prior to this, which is like a CB Insights, Forrester, Gartner type of model, around kind of our entire thesis: how does sports open up massive adjacent markets? So being able to truly lay out and tie back into pain points for some of the largest companies in the world, pain points and opportunity for technology and innovation that's valued now or will be valued in the very near future, right? So it allows you to take guesswork around what is valuable, what is not, and then puts on this kind of, if you look at execution, the ability to execute and the entrepreneur's ability to execute, if put in the right place and they are able to execute and push into and drive this market, it's really valuable, right? So trying to control for as many of those things as possible, which is you know where to aim for. That could shift over time, but you know where to aim for now, and it's valued by a broader market, some of the largest companies in the world now as well. So there's a process in that of having perspective. We always like to, have you earned the right to a point of view in a space? And far too often you see people that are deploying capital that haven't earned the right to a point of view in the space. And every single person on this call will kind of tell you it's not easy, right? It's a painful process of being kind of learned from the ground up. There's a lot of questions to be asked, et cetera. But once that's done, you have earned right to point of view to then understand, what is differentiated, what's not, having perspective of how do you look around the corner with that set of knowledge, right? So I kind of asked, I know there's a long-winded way of answering the question, but I think we look at a variety of different ways. The last thing is we look at portfolio construction and being disciplined around deployment of capital, of check size in, ownership stake. So when there is an exit, our LPs, know that we have a sizable stake and it's meaningful back to them as we look to drive top tier returns. And the space, some small sliver of a company that gets to a multi-billion dollar valuation, if that doesn't move the needle on our actual ownership and capital deployed in that, it's kind of a moot point, right? That's kind of a major differentiator. So being really, really disciplined around that portfolio construction is something we spend a lot of time thinking about and really driving home as well.
Those are great points. I mean, it sounds to me like the crux of it, which I certainly agree with, is that you need to have very disciplined processes, right? And no matter what part of the process you're focused on, it needs to be tight. And if you can I always think about it in terms of marginal improvements across the entire spectrum of processes. So build in airtight processes and then figure out how those are linked and marginally try to be better at them than your peers and try to improve on them each and every day, right? And learn from your mistakes, but more importantly, learn from the mistakes of others. I mean, that's the way we built A.R.I, to take what's out there that I've learned at Deutsche Bank and Scotiabank and Sun Life, and having managed and traded over 50 billion in assets over my career. I learned a lot about what not to do, more so than what to do, to be honest. And so we've developed processes that we think are best in class, because I've already seen the processes that the best folks do, or some of the best folks do, and we're just trying to make them better and better and better and apply them to an asset class that those folks aren't involved in. So I agree with you on that, on the process focus being starting.
One thing that I think is important, and it's really important to us as a fund. So the ability to have a point of view, around what has been done, and then what is truly unique, and then the ability to what might be perceived as really risky to a broader market. You've actually got a really strong point of view of why there's way more risk in this, and here's why, right? And that's kind of being able to answer that question over and over and over again. And I think widening a pool of, for what we look at, the ability to have entrepreneurs from all walks of life being able to have unique ideas and then execute against that, and having kind of a unique perspective, how we've defined the markets, identifying them as early as possible is something that is definitely tied to risk, and also tied to kind of a knowledge base earned as well.
Yeah, I mean, you hit on this idea of being a contrarian, right? And to generate outsized returns, you have to have a viewpoint that's different from the market. Otherwise, you're going to get returns in line with the market, which are pretty low these days, right, in terms of average returns. So you've got to have a process that works, but you also have to figure out how you can be different. It can't just be a process that others are using. Otherwise, that doesn't really add any marginal value. Tunde, I'd love to hear about how your team at Sandbox thinks about investment edge?
And I think I echo a lot of what Isaiah mentioned. I think there's this base level of just doing the work that you have to know how to do in administrating and running the fund. I think something that we key in on, which I can't remember who mentioned it, but someone else has mentioned this, is bringing value and building value. Because of course there's lots of capital ready to be deployed. You know, things are super frothy. So how are you actually going to bring value to an entrepreneur? And so we take a standpoint around relationship and knowledge. I think that was mentioned as well. And so in the verticals that we operate in, what are the things that we can learn and know that aren't common to everyone? And what are the relationships we can build in those places so that when people are entering in, entrepreneurs are coming through, the reason that we're ahead and can have a contrarian view is because there's enough knowledge and understanding within our sphere to know where the disruption is going to happen, to see things ahead of where they come in. And so that is why we've typically operated in markets that are highly regulated, like insurance and food and agriculture and healthcare. Oddly enough, I think when you think about relationships and knowledge, and there is an element of that, I think, in sports as well. And a lot of the places that, you know, these gentlemen invest in too, like everyone can see things from the outside, but there's a whole bunch of complexity underneath the surface that it helps to know the right people, but also to have the understanding and knowledge to know when things are going to change. So yeah, I think that is our primary thought. And of course, within that, I think we do aspire to a number of principles so that our investing is disciplined, and a lot of those principles have come from failures that we've made. So learning from those is really important as well.
Yeah, you hit on a great point, which is with early stage companies, the investors can add a lot of value, and not only can they add value, it's a main differentiator in terms of how they bring value to not only the portfolio companies, but ultimately to the LPs and their funds. And it's something that I didn't have the opportunity to do in the public markets when I was trading names like Apple and Microsoft and Exxon and JP Morgan and Goldman Sachs. I've traded billions of their debt, but no matter what I did, no matter what my view was, it would not matter, right? I could opine all day on how to make them better companies. It wasn't going to matter. However, now with the companies we work with and with all the folks that you work with, you can actually take a company and add real value. And just by investing in that company and helping them leverage your resources, it inherently makes that company more valuable. If the company's worth X the day before you invest, it's going to be worth more than X after you invest because of your involvement. And that's something that I think is incredible, that's unique to early stage companies. So Hunter, I'd love to hear about how you guys are thinking about edge at Next Play.
Next Play is a little unique because we're a fund of funds. So I would give a little background just on the venture asset class in general to say that probably more so than any other asset class, there's very much kind of a haves and have-nots in venture. So if you look at like PE, middle market buyout, or you look at hedge, the difference between the top decile or the top quartile and the next quartile down is in any given year usually like 300 or 400 basis points. In venture capital, it's 3,000 or 4,000 basis points. And the result of that is that everybody that knows the industry wants to be in the best funds. And the problem with that is that even the very best funds, whereas in venture, in private equity, Apollo or Blackstone or whoever's going to go out and raise a $30 billion fund, there's a ceiling on how big funds can get in venture capital while still executing a true venture investing strategy. So you get this pinch point to the best firms where they can be extremely selective about who they work with. And so some people call venture an access class rather than an asset class. So what Next Play has done is build itself around allowing people to get access to the best funds and deals in venture capital. And one of the main ways that we've done that is by the way we have constructed our LP community. So the team owners, the athletes, many of whom are very high profile guys, the front office execs, the family offices of groups like Publix or Ashley Furniture or whoever it is. These are groups that can really help move the needle for some of the companies that our fund managers are investing in. And so between that, kind of having a strategic LP community, and just the fact that over time, NextPlay has done a really good job building meaningful relationships with these managers. We've earned our place with those funds to increase allocations over time. And we've also kind of earned the right to be at the front of the line for co-investment opportunities. You take a fund like True Ventures. True was the original seed and Series A investor in Peloton. So as Peloton really started to scale, they brought that deal to us directly because they wanted some of our athletes to be involved as ambassadors for the company. What that allowed NextPlay to do is then create a vehicle to allow some of the members of NextPlay's community to invest directly into Peloton. That obviously has a happy ending. But part of the secret sauce of NextPlay is around taking the best venture capitalists and the best founders and this very unique community of LPs and kind of putting everybody in the same room and allowing that community to help each other. So everybody's bringing something unique in terms of their own ways of pursuing excellence to the table, but everybody's also getting something and learning something from someone else in the room. So a huge part of NextPlay is around community. It's around education. We do a lot of events like our annual event, which Kelvin's actually spoken at it a few times. It's called the Bridge Summit, and it was virtual this year. That Bridge Summit had 700 or 800 people on it, probably half of whom were athletes. And so even though of those 300 or 400 athletes, probably only like 30 or 40 of those are LPs of ours, that shows that there's a ton of demand in the sports world to learn more about the venture capital asset class and the world of startups in general. And part of our mission, even independent of the fact that some of those guys might eventually become LPs, is to help them better understand what venture capital is and to not invest in their cousin's startup, which is bound to be a bad idea, but to approach this very outperforming asset class in the last 2 decades and allow them to do it in a safe way where they're not going to lose their skin and they're going to have a real chance to take what they've earned in their sport and to roll that into whatever they want to do next in their second career. So for us, it's a big community piece that really kind of drives our access. And then from there, it's pretty personal relationships with a lot of the fund managers that generate a lot of our deal flow on the direct side.
You hit on something that I talk to LPs a lot about, which is this idea of accessing innovation as an asset class. And a lot of folks outside of the VC space don't realize that it is hard to get access to those top managers. And to your point earlier, it's really the top managers that outperform, and you don't want to be going with the average or below average managers, certainly. So interesting to hear your thoughts on that for sure.
I do want to say one thing around that.
Mm-hmm.
Over the last 20 years, emerged the top kind of quartile of emerging managers, particularly on the venture side, has lapped in a major way some of the top performers. And a lot of that is around kind of new insight coming in, but also when you have massive assets under management, there's only so many deals you can do to kind of truly move the needle as well, right? So you look at a gap into entry point and then kind of scale as well.
Totally. Yep. I mean, it's
just to add to what Isaiah was saying, most times those are fund managers with their first or second fund that are driving those outstanding returns, because they've either spun out of some of these, huge shops that have, huge AUMs. But that data does suggest that those fund managers, first fund, second fund, have some of the best returns in that particular vintage year.
I'm so glad that you both hit on that. The idea of emerging managers actually being the biggest outperformers and providing the most access to alpha. The data shows that. So there's this conundrum, right? In that allocators know that, they've seen the data, but they're still risk averse because, you know, if they invest in a first time manager or in a fund two that's relatively early stage and it doesn't go well, you know, they're putting a lot of their own career at risk. So there's that career risk that allocators have to manage, which I empathize with. We all have to do that, right? But it's contradicting what they know to be true, which is if you can identify the best emerging managers in various asset classes, in this case VC, you're going to outperform, right? And you're not only are you going to outperform, you're going to attract more capital to your business because people are going to say, hey, this allocator knows how to find opportunities and access these opportunities that others can't, right? And so it's interesting because everybody knows it in the allocator community, but few people act on it. And then the folks that do act on it wind up outperforming. So I would think that at some point there's going to be a follow the leader mentality. There has to be, right? Where people start to say, okay, if this is what works, maybe I should do that. But of course, there's a drag on that because of the career risk that's inherent in investing in early stage managers. So that's this problem that really hasn't been solved by the market. But it's an opportunity, I think, for a lot.
And I love what Hunter said about access.
Courtney, we're not hearing you again, unfortunately.
My connection unstable.
Yeah, it's tough.
I'm gonna sign off. Let someone else answer.
Let's go. Kelvin,
I'm really excited to hear that answer too.
Yeah, me too.
It was gonna be really good.
Courtney, why don't we do this? I want to ask Kelvin a question. You want to? We're almost out of time, but I was thinking maybe.
Yeah, just ask Kelvin a question.
Well, Kelvin, I was going to ask you if you had any follow-up thoughts on what the guys have said, but also I wanted to get your thoughts on risk. When people come to you, right? They know you're plugged in. They know you've got access to capital. They're probably pitching you ideas all the time. How do you make sure you don't lose money? Like what are the things that go through your mind in terms of risk management?
And, I'm going to answer that, but I'm going to first start by saying there are a couple of things that were said that were right on point. You had Hunter that talked about, this being an access class. You had Isaiah talk about you have to earn the right to have a point of view. And for me, I take that approach just a little bit further. And I say you have to earn the right to actually get on the cap table. And for me, that's been what I've had to do to actually get on the cap table, to understand what risk looks like. And the thing is I kind of got the cheat codes in a little bit because one, I have capital, I'm still playing currently. And then I not only do direct deals, but I also do fund deals as well. So I got deal flow that's coming through funds and funds across asset classes. You got hedge funds, I got buyouts, I got PE, I got venture funds. I mean, I got cattle back at home, so I look at stuff in the livestock market as well. I got a art portfolio, so I look at stuff on the art side as well. So I get to come at it from a lot of different angles. But when you think about risk, for me, Isaiah hit it on the head. When you have to go back to your LPs and say, I have a 10% stake in a multi-billion-dollar company, that's a lot different than saying that I got $300,000 in a $3 billion company. It's a completely different type of conversation. So when I think about risk and how to mitigate risk, where's the deal coming from? Where's the opportunity coming from? And then for me, I'm big on my network. My network is what drives my value and what drives my returns. It's also what drives the access for me. So for me, I've identified experts in the categories that I find most valuable and also in the categories that I don't have the most expertise. And I'm not talking about experts because somebody called them an expert. I'm saying expert because of what their returns from a vintage standpoint, whether it's a fund or over the life cycle of a fund, what their returns suggest. So for me, that risk has been mitigated first of all, just about where I got the deal from and which expert that came from. And then as it pertains to actually making the decision about whether to do a deal or to do a fund, what is their structure? How do they plan to be able to attack that market? And then understanding the risks that are associated with it. And then for me, it's like I've been able to go into different markets where I know things are de-risked just based off of what they're doing. Like I'm not, everybody's, all gung-ho about Clubhouse. Like I can talk about that for hours on end, because that's different than what Courtney would look at, like a data company, or what Isaiah would look at, based on a sports-centric type of company. So it's different because they provide a different level of expertise. And when you think about deals that are being sent to guys right now, where is it coming from? And do you have somebody in your network? If you don't have the expertise, can they provide you that expertise? Can you pick up the phone, and provide that expertise? And I think that's where, guys don't think about that and don't put the necessary rails in place. And again, I give credit to where credit is due. Courtney, Tunde, and Isaiah and Hunter, they've provided rails for themselves to be able to either go to and be able to have expertise within certain areas to make very risk averse, but also risky bets on things that they either know or they have the network to know or get the information and to know what type of decision they need to make. And I hope that answers the question. But for me, it's one, you got to have the experts either in your network or very, very close within your circle. And then you have to realize there are access issues that go on within not only the venture landscape, but within multiple markets. You're not going to just go up to Apollo and say, hey, Apollo, take my money. You're not going to go up to Elliott Management and say, hey, Elliott Management, one of the best activist investors out there, hey, can you take my money? Like it's an access issue that goes into every single asset class. It's just, I would say, the quote sexiest asset class, because it's both risky and also has, very, very high returns. Venture is somewhat something that everybody wants to have within their portfolio. But, both Hunter and Isaiah have talked about this. Portfolio construction, that's a completely different, area that people don't even think about. And I'm not talking about portfolio construction from an endowment standpoint, even personal portfolio construction. Do you have it weighted in a way where you can be able to make the necessary moves, move money in a way that it needs to move, pull money in and out of markets the way that you need to move, have it understanding the whether it's liquid or illiquid, and what have you. It's being able to understand the way money moves, how money moves, who's moving the money, the different levels of money. I mean, you got the GPs, the LPs, you got the endowments, and there's different levels to the endowments. Do you understand like the ups and downs and the back ends of these markets to be able to make educated decisions?
Yeah, I'm going to jump in. Hopefully I won't cut out. Let me stop my video, see if this works. And I love what you said, Kevin, about portfolio construction. A lot of guys that don't understand that constructing a portfolio, even again on $100,000, doesn't mean you put $50,000 into someone's venture. It's a portfolio constructed of liquid, illiquid, stocks, bonds, real estate, venture. For some people, depending on the level of risk they want to take. But I'll also say one other thing before I get frozen out is my partners, when I started in venture about a decade ago, my partner said, Courtney, you have a lot of knowledge and a lot of different things, but the thing you need to do to really start learning is you need to look at 10,000 crappy deals. And I said, oh, the deals that you cast off, they're like, no, not the deals that we cast off. You have to look at crappy deals before you even start understanding what a good deal looks like. And so for me, that was a long, arduous, frustrating process, looking at deal upon deal upon deal upon deal upon deal. Before I even get to the point of looking at a deal, understanding it, pitching it to my partners, and then them saying no because you missed a couple of points, either on the actual addressable market or again on something that maybe is a little more technical, understanding that, well, the implementation into companies is going to be arduous, and the timeline to customer adoptions is going to be too long for us to even consider this deal, and we don't have the way to de-risk it. So I love what everyone said about this asset class. And again, I'm honored to have been on this panel with everyone. And for the LPs and allocators, I think there are 6 people who have funds that you could definitely put some money towards.
Courtney, thank you. Finally we could hear you. I'm sorry your connection today wasn't too great. I just want to mention in terms of the risk management part before we go, I always think about it in terms of, do I really understand this company's business? And more importantly, or equally as important, do I believe that the leadership team at this company is going to deliver on what they're telling me, right? So especially with very early stage companies, when I'm look at angel stage companies and on the personal account side, not for my fund, but for just my own portfolio, I'm just like, do I trust this person? Is what they're telling me achievable? Do I understand it? And are they going to go out and do it? And that's always the starting point for me in terms of many things that go into the risk management process. But really, it's, does this person have credibility and can they execute on what they're telling me? So I wish we had more time. Shoot, we're 90 minutes in, and we could probably talk another 2 days on investment strategy alone. So I just want to thank you guys for joining. This has been great. Maybe we should do another one of these and really dig into some of the nuances of investing later this year. I think that would be a lot of fun, and definitely look forward to collaborating with each of you and your firms personally. And if folks that are listening would like to get in touch with any of the panelists, they're all on LinkedIn, but if you email me, I can make the connection for you, and happy to do that. And you can always learn more about our fund at ARIBC.com and email me at zellison@ARIBC.com. So thanks for tuning in, and hope to see you all again soon.